Appreciate you watching this video from NetPicks. And recently I made a video called The Truth About Big Price Moves. So hope you watch that video. And essentially, big price moves are often the catalyst for having a trader take risks on that next move due to the fear of missing out because they missed that first move. So in that video, I pointed out that a trader is not always responsible for that first big move in price, because oftentimes big moves can come out of anywhere. But when you do see a large move, something changed. Now, whether that's going to equal another large move, who knows, right? But that large move has put you on alert. And if you do miss that next move, well, that one is on you. So I want to go over the charts that I talked about because I want you to understand that you need to be clear on how you trade. And you'll see that in this Ford chart coming up. And I want you to accept that even great patterns can fail. And we'll see that in the Airbnb chart. And you'll see that oftentimes the bigger picture can alert you to market trading conditions. And we're going to see that in the ES. Now, all of what you are going to hear and the approaches that I mentioned, this has all been talked about in virtually every video we have. So none of what you're going to hear is made up on the fly to suit these particular charts. So looking at the chart of Airbnb, this stock had a large move out of a pullback, and it was setting up a potential bull flag. So I want you to keep in mind that overall, the market was still bullish. Okay? And on charts such as the daily and the weekly chart, taking buys are the safer bet. But in that video, I did mention that I did not want to see momentum coming into the flag to the downside. Because if it did, then for me, a long trade is off of the table from that pattern. Well, the day after that chart was posted, momentum did step into the stock, right to the downside. Now, there are two ways that a pullback is going to fail generally. Number one, price will begin to form a trading range. The second is there's a momentum push in the direction of that pullback. So looking at this chart, this is not something that I'd be looking at buying now. And we could really see a price tag of about $133 to $135 for this stock. If you're a shorter time frame trader, you may look to buy little bounces. But as a daily chart trader, this one is off the radar for me at this time. And what I do need to see is price holding some level of support before looking for a buy. And it could be in that price zone of 133, 135. Oracle. So this stock had a large gap off of almost 20%. So I mentioned that if you are a trader that looks to trade gap fills, well, now this next move to the downside, you would be responsible for. In fairness, there is no signal in price that this gap up is going to happen. Now, how you trade a potential gap fill, that's going to be different than another trader. But the key point is that there was a gap up. There was a reversal off of this gap up. That's the move that you are responsible to trade. So if you missed it, and that's your strategy, and you scan for these, or you trade this ticker and you didn't trade it, you didn't do your job. And that just hits home the point that sticking to your trade plan is the most vital thing that you can do as a trader. Now we look at the S&P E-mini. Price had pushed higher, and it was consolidating at a price zone that was acting as resistance. And when that happens, it's generally bullish. And if you miss that first move up, and I say missed with quotes so we can hear those, you're actually looking for a push up from this zone. When we have momentum pushing price into resistance like this and then basing, that's bullish. But what happened was this was a clean looking consolidation, turned ugly. And it's a great example of why a trader must be clear on their setups, their entry triggers, and their protective stop locations. Now, if you look at this chart, price didn't post a strong close in either direction, but it certainly did take out both long and short traders. And how do you know this? Because there's a pattern called a megaphone pattern. You can call it a broadening formation. You can call it an expanding range. The label of the pattern is absolutely irrelevant if you understand the price action that is taking place and what it means. This is a 4-hour chart, and the little inset is a monthly chart. And on the monthly chart, what you're seeing now is an outside bar. We see that price made a higher high and a higher low and a higher high. That's bullish, right? That's an uptrend. But then price then drops through the higher low, makes a lower low. So anyone that's long gets taken out. And when that higher low was taken out, sellers, no doubt, came into the market. But then we see price take out a swing high, puts in a higher high, takes out shorts. No doubt, got longs into the market. And then we see price breaking back down and putting in a lower low. You get the picture. Now, if you flip through a whole universe of stocks, you're going to see that this past week, trading would have been a little bit difficult if you're trading slightly higher time frames. This is Ford. Now, it's not the most exciting chart to trade, but we did recently have a consolidation and an upside breakout taking place. Now, the point of this chart was that unless you trade the actual breakout or you position at the low of a trading range, you would not be in this trade. And you would also not consider that you missed it if you trade breakouts by looking for a pullback or a consolidation. But that bullish move out of Ford was short-lived. Price failed to hold above that breakout level. Now, some will call this a failed breakout, but in fact, price did break out and just failed to hold the level. I call it a breakout failure, and some of you are probably say, you're just mincing words, but for me, I just prefer to be a bit more precise in how I speak. Now, a trader that uses a breakout pullback to enter these, they're not having any FOMO on the next move because their plan would be no longer valid the moment that price was holding acceptance inside that range. Now, that reversal candle, that just put the icing on it. If you were still looking long and that showed up, I'm sure you threw in the towel and putting this one on the back burner for now. I just want to show you those charts, and I tell you, it would have been easy to change the channel and say, hey, you know what? We did take that short on Airbnb. Okay, we would have looked like geniuses. And a lot of traders do that, or quote, traders do that. But that's not going to help you. I could have used a lower time frame from the original chart and found an entry short. That would have been very easy to do. But that's not my approach to swing trading. But I will use a lower time frame for an entry trigger into a higher time frame setup. It's different. I think this was a good selection. It showed pattern failures, successes, and how the market can move to stop out both longs and shorts really easily. And I hope that you realize that you need a trading plan and you need an approach that fits you. Nothing can be left to chance. Okay, and I do have some discretion in my approach, but there are enough rules that I follow that keep me from doing stupid things. Is it perfect? Absolutely not. But I can say this, FOMO and the impulse to do things that could demolish my account, they don't really happen anymore. And I want you to feel the same way. Thanks for watching. Hit like, hit subscribe. Talk to you soon.